Welcome to The Critique. Today, we're looking at a piece analyzing the global iron ore market, specifically that big question mark around 2026. Will new supply, mainly from Simandou, tip things from today's tightness around, $104 a ton, into a surplus? Let's dive straight in. Okay, first off, the analysis does a really good job laying out the supply-side argument for 2026. It's strong, well-sourced, details miner output, Simandou's ramp-up. It feels solid. But, and this is the key point, to make this a truly robust risk assessment, it needs to work harder balancing that certainty of supply with the, let's call it the fragility of demand.
The supply, they feel pretty locked down. BHP hitting close to 290 million tons, Rio's guidance 323 to 338, Vale lifting output in Q2.
Right.
And the big one, Simandou, pulling first shipments to November 25. That's the real game changer volume-wise, isn't it? That fixed supply, it's the anchor for the whole thing.
Exactly. And that's where the weakness sort of emerges. Because compared to that specific, quantified supply picture, the demand risks, well, they feel a bit generalized. Things like China's property issues, the slow creep of EAF steelmaking, Western policies tightening up, they're mentioned as factors, sure.
Just tempering factors, kind of waved at.
Yeah, exactly. The piece lands on this idea of a mild surplus if China doesn't roar back. But what does mild mean? We don't get a number tied to a specific downside demand scenario. We've counted the incoming tons meticulously, but the tons that might disappear, much fuzzier.
And if the core story is about this shift, 100 ore tight now, maybe loose later, mild just doesn't cut it. We need a sense of scale. So the suggestion here has to be making that structural balance section do more heavy lifting.
How so?
Well, explicitly integrate that known supply volume Simandou, plus the steady majors with some properly quantified downside risks for global steel output. Don't just list the risks, model them.
Okay, that makes sense. It anchors the whole surplus idea in actual volume figures, takes it from just being directional to something more predictive.
Definitely. And a concrete way to do this? Maybe introduce a brief scenario analysis. Let's take China's steel output. It's hovering around 1 billion tons, right?
Roughly, yeah.
So model what happens if you add, say, the first phase of Simandou, let's call it 50 million tons, potentially within 30 months, against a defined permanent drop in that Chinese demand. What if the property issues mean, a sustained 3% cut to that billion-ton base?
Right, so you're putting numbers on both sides. 50 million tons coming in, maybe 30 million tons going out from just that one China scenario.
Exactly. Suddenly you have a potential net surplus of 20 million tons just from that simple pairing. It gives the reader a concrete number to grapple with, much better than just mild surplus. Tells them how mild or maybe not so mild.
Okay, I like that. And we could apply that same thinking to the policy risks too?
Absolutely. The piece mentions the Brussels policy proposal, the idea of having tariff-free steel import quotas.
Yeah, it's flagged as a risk.
But we can quantify it, at least partially. Move it from just an abstract worry about EU policy to a calculated potential removal of iron ore demand.
How would you model that, though? It seems complex, tracing steel flows back to ore demand.
It is, but you can approximate. You figure out the volume of steel imports that would be impacted by that quota change. Then you work backwards. How much iron ore, roughly, is needed to make that much steel? It won't be perfect, but it turns that EU risk from a footnote into potentially another quantifiable chunk of demand destruction, adds real weight to the demand fragility argument.
Got it. So quantify the downside scenarios, connect policy to tons. That makes the balance much clearer.
And once you've established that potential surplus, and maybe its size, the very next question is, okay, where does the pressure hit hardest? Because everyone assumes, the high-grade stuff is safe. Quality premiums will protect it.
Which leads us straight into the second main point.
Exactly. Which is about digging deeper into that quality split.
Right. Our second critique focuses on that insight. Quality premia could cushion top-grade ores. It's a good observation, but it needs more specificity about who isn't cushioned, particularly which mid-grade segments are really vulnerable. The analysis correctly spots the big structural trend, doesn't it? the move towards high-grade, low-impurity ore. Steelmakers needed for decarbonization, ESG pressures, all that.
For sure.
And it rightly points out that the top stuff, Simandou's expected grade, Karajaw's finds from Vale, some of the better Pilbara blends, they'll likely see those premia hold up relatively well.
Yep, the 65% FEI index versus the 62%. That spread is key.
And then it says mid-grade ore may feel the squeeze first, which again is probably true.
But it's too broad. If we're trying to pinpoint market inflection points, especially around that $100 level, just saying mid-grade isn't sharp enough. Which mid-grades? Based on what characteristics? Which origins? If the market's going to fracture under surplus pressure in 2026, we need to tell the reader where those fracture lines are likely to run.
Requirements directly to specific mid-grade sources. Give clearer signals about where the pain is most likely to show up first when that surplus hits. Identify the marginal tons.
Exactly. The natural swing producers, or maybe the ones that become uneconomic first. Let's think about a couple of examples to make that concrete.
Okay.
First, think about the Pilbara in Australia. The piece mentions regulatory stuff, right? Closure costs, rehab obligations. These things are getting sharper, more expensive.
Yeah, environmental pressures are rising globally.
Well, how does that specifically impact costs? It likely hits the older, higher-cost operations harder, doesn't it? And sometimes those are the operations producing, well, perfectly decent, but maybe not top-tier, mid-grade ore.
So higher regulatory costs could specifically squeeze the competitiveness of certain Australian mid-grade tons against, say, other seaborne options. If their cost floor rises, they become more vulnerable when the overall price drops.
Precisely. They might become the first ones to dial up output or even halt operations if the price dips towards, say, $90 or $80. That makes them a key part of the global swing supply. It adds a crucial layer to the Pilbara story beyond just the big benchmark blends like PB Fines or Lump.
That's a good specific angle. What else?
Well, we also need to consider new or growing sources of supply that might compete in that mid-grade space. India comes to mind.
Right. The piece hints at rising Indian production, mentions NMDC figures, the export duty debates.
Exactly, so we need to evaluate where that Indian ore fits. If New Delhi allows more exports, where does it land in the quality hierarchy and what's its cost position?
Because if that Indian material is, say, a mid-grade product that competes directly on cost and quality with some of those potentially higher-cost Australian mid-grades,
Then you've identified a specific point of competition where the pressure is going to be intense. That's where the squeeze happens. It takes the analysis from just a general comment about quality tiers into a much more focused, almost geographical, risk assessment of who gets displaced first.
okay, that definitely sharpens the picture of the shifting power balance in a surplus market. Good. Now that brings us to the final section, the wrap-up and look ahead. Right. The third point is about strengthening the what-to-watch next structure. The current list, the Skillings quick checks, it's useful, it has the right elements in there, but, well, it feels a bit like a laundry list.
Yeah, it suffers from that classic analyst problem, doesn't it? Everything seems important, so nothing really stands out as the thing to watch. It's a lot of signal noise.
Exactly. The current list mixes very different types of risk. You've got logistical things like potential delays at Simandou's port or railway, or safety issues causing stoppages.
Execution risk, basically.
Right. Then you've got fundamental policy shifts, China's property market stabilization efforts, the pace of EAF adoption, those final EU trade rules.
Big structural demand drivers.
And then you also have just routine company updates, the majors tweaking their guidance, all relevant, yes, but throwing them together in one checklist kind of dilutes the analytical power. We're not helping the reader prioritize.
So we need a better framework. Give the reader a way to immediately categorize a news headline and understand its potential impact on the 2026 surplus story.
Exactly. And the suggestion here is pretty straightforward. Cluster these watch points into two distinct strategic buckets. First, supply execution risks. These are the things that primarily affect the timing of when that surplus might arrive.
And second?
Second, demand policy and structural signals. These are the factors that will likely determine the magnitude of the surplus when it does hit. Timing versus size.
Okay, I like that. It brings immediate clarity if you read about, say, a landslide impacting Simandou's rail line.
That goes in the timing bucket. It likely pushes the surplus arrival date back, maybe into late 26 or even 27.
Right. But if you read about China announcing a major credible stimulus package for construction.
That hits the magnitude bucket. It might mean the surplus, when it comes, will be smaller than previously feared. It's a simple but powerful framework for interpretation.
So let's flesh out what goes where concretely.
Okay, so create a specific section, supply execution risk. This is where you put things that affect the clock. Definitely Simandou progress, port and rail readiness, hitting those shipment dates, and crucially, explicitly state that delays just shift the surplus risk. They don't eliminate it.
Good point. What else in timing?
Major minor guidance updates. You know, the quarterly production reports, any flags raised during investor days like Vail Day, or in BHP's operational reviews. Are they consistently hitting their numbers, or are there operational hiccups creeping in that might trim overall supply slightly? These are the clock adjusters.
Got it. Timing bucket handled. Now magnitude?
Right, second section. Demand policy and structural risk. This focuses on the factors determining how big the surplus problem could be. Number one is obviously China's steel policy. Is the property market support real stabilization or just talk? What's the actual confirmed pace of the EAF shift versus relying on blast furnaces?
Key demand drivers there.
And then, the finalization of those EU trade rules, the quotas, the potential tariffs, and critically, the knock-on effects for steel trade flows globally, not just into Europe directly.
Because steel that can't go to Europe might try to find another home, impacting other markets.
Exactly. So this framework, timing versus magnitude, gives the reader a clear map. It tells them which news flow affects when the market might tip versus how far it might fall. Super useful for navigating that potential volatility around the $100 mark.
Yeah, that's a much more strategic way to present the watch list. Much more actionable for the reader.
Okay, let's wrap this up then. In summary, the foundation here is strong. The piece does an excellent job detailing the supply side, particularly the majors holding steady, and the near certainty of Simandou's arrival. That sets the stage really well for this 2026 surplus narrative.
Definitely. But we have 3 key actionable steps to elevate it. First, get specific on demand risk. Move beyond just saying demand is fragile. Rigorously model that interaction between the firm's supply coming online and potential quantified downside demand scenarios. Put a number or a range on that mild surplus by stress testing it against, say, a specific drop in China's steel output.
Second, sharpen the quality split analysis. Don't just stop at mid-grade is vulnerable. Dig deeper. Identify which specific mid-grade segments are most exposed. Is it higher-cost Australian tons facing new regulatory burdens? Is it segments facing direct competition from new Indian supply? Pinpoint where the pressure will likely hit first in that 2026 scenario.
And third, restructure that final what to watch section. Ditch the laundry list. Group the factors into those 2 clear categories. Supply execution risk, which tells you about the timing of the surplus, and demand policy structural risk, which informs the potential magnitude of the surplus and the pressure on that $100 price point. It gives the reader a framework for interpreting news flow instantly.
Excellent. These steps should significantly strengthen the analysis and its predictive power regarding the shifting iron ore balance. We look forward to seeing the revised version. Please feel free to submit it back to the critique for another look once you've had a chance to incorporate these points.